just entered the trading pit, your home for sophisticated takes on the crypto markets. It's April 16th, and here in the studio is JJ and Ben Lilly of J Labs. I am your host, Marconi White. Woo! Wow, Bitcoin and the altcoin market finally got the pullback we've been discussing for months. But what does the next 3 months look like? V-shaped bearish chop or the dreaded liquidity event? We're going to find out, but first, it's rapid fire, where I look for simple answers to complex questions. Gentlemen, let's get started. Ben, I'm going to start with you. Mark Cuban says he's happy to pay taxes. Is he actually happy? Is he just virtue signaling as he pays $285 million?
Virtue, just wants people on his side.
He wants the good vibe. He wants to feel like
we've been attacking him too much lately. He wants to be friends, guys.
Okay, yeah, he just wants some chums. You can send some of that cream over here. All right, JJ, when Bitcoin actually hits 100K, how are you celebrating?
I guess it depends on the time of year, right? So if that's in July, we'll be lighting off some fireworks, but who knows? We'll have to wait.
You're not going to do it mid-January somewhere in the Arctic?
No.
Okay. All right. Stay warm. Stay warm. All right, Ben, this pullback, end of the beginning or beginning of the end?
We're just getting started.
Oh, you're gonna crush some souls on this one.
No, the meat is ahead of us. It might be a little bumpy here on the short term, but the best is yet to come.
All right. Well, that's a little bit of a horizon I could get along with. JJ, Norway's crackdown on data center usage for Bitcoin. Is this a one-off event or a sign of more government resistance to the Bitcoin?
More government resistance. I think we're in that meme. Was it first they laugh at you, then they fight you, then you win. So we're at the fight you face pretty firmly, I believe.
So get out your flak jacket and be prepared, figuratively speaking. I don't think anybody's actually going to war on this one, at least not yet. All right, Ben, you've got to deploy cash. Are you buying Bitcoin, L1s, or memes?
Ooh, I'll probably be looking at L1s here for the next 3-4 months.
Okay. All right. We may actually have some options to talk about later in the show, although I think outside forces is definitely get a major play on today's show. We'll see. All right, JJ, last question here. When your wife asks if you bought the dip, do you tell her the truth or do you lie?
You have to lie. You can't let your wife know how much you're actually throwing around here. She might get some crazy ideas. Yeah.
You don't want your wife to know how much of a DJ you are? Is that what you're saying?
Yep. You have to keep it on the low. You can't let her know your wins or your losses. You just have to play it cool.
Okay. Well, guys, this isn't financial advice, but it certainly is marital advice. We're willing to give that out any day of the week, any day at all. I want to give a shout out to Light Signature, KS, Andy, Gabrielle, David, Adrian, Sal. Thanks for joining us. Happy to have you here. Hit the like and subscribe button. Share this with anybody who wants to have a take on the markets. We are going to be getting into the pullback. We're going to be talking about Bitcoin, outside forces that are definitely going to play a major part in what happens next. And I will unpack some scenarios, which I think is going to be really interesting. But first, we got a couple of stories that are very much top of mind. The first one's about Ethereum. Now, according to the block, Ethereum validator queues have hit their highest levels since September of 2023, which is now way in the rearview mirror. And according to this article, investors are looking at staking to use their liquid staking tokens on Eigen Layer. And interesting stats here, about 32 million or roughly 26% of ETH supply is already staked. And some ETH researchers have caused a stir recently talking about maybe reducing or creating an incentive to reduce the amount that's staked. And they didn't really give a specific target, if it'd be 25% or higher, but basically at some point creating the mechanism that it would actually have negative rates on Ethereum staking. So Ben, I want to ask you, as someone who's researching ETH's yield to calculate a crypto risk-free rate, what do you make of this recent uptick in interest in staking, as well as the proposal that came down from the researchers?
Yes. So I guess the conversation began back in, I think it was February was when the forum started taking off. And I haven't really been able to spend the time to get fully up to date with it. But it's, the fact that this conversation is happening, I think it is healthy. Like there should be various dialogues because a lot of folks are going to offer unique perspectives that I think a lot of people hadn't considered. Because when we think of economics and crypto, we tend not to use the common like macro type of economist approach. It tends to be more of like the economics of security, the cost to go ahead and secure a network. And now that we have yield and we're starting to have yield curves emerge and the possibility of sort of this risk-free rate within Ethereum itself, it's almost like a shifting of what is economics in crypto. And so having these unique perspectives come to surface, I think it's just healthy. It's healthy dialogue. As far as like, is this an issue or not? I think from a computer science perspective, I'm not the person to go ahead and really discuss that, but at least the mechanism in terms of why this is really taking place is, if you go ahead and you go on DeFi Llama, and I think you look at the total value locked in the protocol rankings themselves, you got Eigen Layer right there in the number 2 spot. Of course, you got Lido up there in the number 1 spot, and then you got Pendle down there below. We can tell what the narrative is that's causing this dialogue to really surface. And this kind of goes back to even those forum boards where they were talking about these liquid restaking tokens, which you use a liquid staking token to start with, and then you can go ahead and restake it, and then these L2s can really rent essentially your Ethereum or kind of validator set to go ahead and secure their chain, and then they get compensated or just go ahead and make that payment, if you will, for that security. If we go back to what DeFi Summer was in 2020, there was a compensation for anybody that was willing to drop their liquidity on a protocol, and this was a way that protocols could bootstrap liquidity. I forget the guy. I think it was from Polychain that went ahead and did this. He was the one that really started it with Compound. But here you kind of have a similar aspect here. If the L2 needs to go ahead and bootstrap security, this is how they're going to compensate, is with these tokens. And so Eigen Layer, that is one of the best ways to go ahead and play this trend. Pendle is giving good exposure to it. That's why Pendle's so high up on the list. So is this a good dialogue to have? Absolutely. There's a lot of risks involved. There's a lot of kind of Legos being stacked to make this possible. So I'm glad to see it for sure.
Very interested to see how this, do you think this has any stabilizing price mechanism on Ethereum with so much being locked up?
Well, Athena is kind of the one that I find more interesting than anything. Just the fact that you want to go ahead and drop your ETH within Athena, and then they put on a short position that's going to go ahead and suppress volatility to the upside, because funding rates start to spike, yields start to look attractive, and then you go ahead and want to, you have that moment in time where you decide, you know what, I want that yield. So you go ahead and decide to not take the upside of ETH. You take your yield on a stable synthetic dollar, I should say. But then when that gets unwound, that's going to reduce volatility to the downside. So the fact that this product exists, a structured product exists in the ecosystem, that's going to reduce overall volatility moving forward. And as far as what's going to happen with the kind of Eigen Layer liquid restaking tokens approach, that's a little different, because it actually can create even more volatility. Are they going to go offset themselves? I know I'm contradicting myself right now because I'm thinking my way through this a little bit, but this has to do with tokens becoming illiquid. They're going to this higher form of usage. They're getting compensated for it, and that creates this price inelasticity. That means every 1 unit change of demand creates more than 1 unit change in price. So moving forward, at least during this narrative trend, you could have volatility go either way, but having products like Athena that take advantage of the yield, that's going to offset that uptick in volatility.
Okay, I promised myself, and I promised you offline, that we weren't going to get too much into the weeds on some of these topics, and I feel like we could, because there's so much meat that you just put on the table. So I think to sum it up here, you're saying this is a good dialogue to have. They need to be having these discussions from a price standpoint. Products like Athena are probably going to have, perhaps in the near term, on a bigger sway with the way that the structured product works, and perhaps suppressing price until it's unwound. I'm going to say, for anybody out there, if you're interested in getting more into this, let us know in the chat, because I think we're going to do a one-off episode, cover some of these topics and explore them more, and give Ben more time to unpack them, because we've got a lot more that we've got to cover today.
If you want to sum it up, I'll try to sum it up real quick. Like, this conversation is creating a change within Ethereum of, if it's a network economy, this is the cost of capital for ETH. This is kind of the federal funds rate. that discussion has to happen. This
Yeah.
is the maturation of the ecosystem. It's a good thing.
Okay, it's a good thing. It's a good thing. It's positive for all you long-term ETH holders. But definitely price action could be something a little bit different. JJ, I want to bring you up here, get your take on this weekend's altcoin bloodbath. Total 3, which excludes BTC and Ethereum, dropped 24%. And even the majors like Solana, when I looked it up this morning, they were down about 25% on the week. And they still look very much like they're vulnerable. And there was a post here from Thicky of, I want to say, Scimitar Capital, which was interesting. Found out on X. He noted that the altcoin sector added about $17 billion of supply. I think it was year to date through unlocks and staking rewards, and that the receivers of these coins, their behavior was basically just to hold on to this and wait for an event. That event happened, which happened to be the potential of a war starting in the Middle East between Israel and Iran, which just caused all this liquidity to get drained out of the system. So, JJ, I want to get your perspective. Is this an opportunity to buy up cheap alts, or is it a sign that the market needs time to recover when you look at the market structure? Because I think there's a lot of concerns here for many of the altcoins out there.
Yeah, it's a good reminder that market caps, especially on things like alts, they're just always a meme, right? So when you look at an actual market cap, what that is the theoretical value if everybody sold their tokens at the current price today, which we all know is impossible because that liquidity doesn't exist, right? But when you have kind of an easing financial system, when money's easily accessible, you see it flow down the risk curve. So we can see this pretty clearly here when we overlay total 3 on top of the DXY chart. So you can see in times when DXY is extremely weak and there's plenty of liquidity in markets, people are more willing to go down the risk curve, take chances on things like alts that are higher risk, right? So you're more willing to bet on those 1,000x returns. And you can see how this market cap grew from about 30 billion or so at the COVID lows to over $1 trillion at the top in 2021. And then we saw a similar reaction early this year as DXY was weakening in late Q4 last year. Into early this year, we saw obviously total 3 run up again as Bitcoin and Ethereum caught a bid. And then that capital flows down the risk curve. But now that we have DXY rebounding, you see that liquidity flow out, right? So there's people that are tracking things like this or looking at treasury yields and whatnot. People are managing large amounts of money and they don't want to have that allocation down the risk curve, so they pull out. And then you see this quick correction to the alt total 3 in connection with that. So I think until you see a weakened DXY, this will probably continue to fall. And I think that's the signal you really want to be looking for here, is signs that this is bottomed out at the same time DXY is topped, and that might be your entry signal. But until you see some kind of meaningful reversal here, this is basically, these two things are polar opposite, right? You have DXY, which is the theoretically safest asset on the risk spectrum, and the alt total 3, which is about as risky as you can get.
Well, there you have it. If you're looking to buy up some entries, and even if you're sitting in some of these alts, it's maybe time to de-risk, consider moving into something, including stables. Maybe you start to wait this out. And let's actually get into the meat of today's show, which is to try and look at what happens next. In terms of these recoveries. I was looking at the numbers this morning. Spot Bitcoin was about 62, trading about 62,940. Ethereum just holding on to 3,000, and Solana down all the way at 134. And I think, as I said, it was about 25% down on the week. ETF flows were looking rather weak. I think we had a net outflow of 36 million yesterday, and GBTC continued to bleed 110 million yesterday. And then, of course, we can get into the perpetuals and options. So, JJ, typically we walk through kind of an overall market setup. What I'd like to do today, and we talked about it offline, let's do a little bit of what we're seeing right now, and then we want to focus a little bit more on a couple different forecasts, what sort of different ways in which this could play out over the next couple of months. And I know we'll be getting into outside forces, and Ben's going to jump in here with that. For all those out there, before we get started, definitely hit the like and subscribe button. Come join us every Tuesday and Thursday. This is the place to be if you want a sophisticated take on the market, not just telling you to pump any bags. Definitely think about the best way to deploy your capital. So, JJ, as I walk through the headlines, what are you looking at here that's giving you a deeper insight into what the markets look like in terms of, how robust they are against this pullback, or how fragile they're looking?
So obviously not looking too good right now, right? Like we've lost a ton of momentum. Basically, everything that drove us up through February, a lot of this could be attributed to the New York session. So basically, when the New York session bell would ring, we'd see this auto bid for Bitcoin all the way up to all-time highs. And then once it topped out, that faded. So the two kind of legs up that we see here at the end of March and then last weekend, these are both Saturday into Monday sessions that were driving price up, and then they eventually sold off throughout the course of the week. And now we've lost kind of this entire momentum that we rode up, which was the 50-day moving average as well as this 50 RSI mark. These were the two things that we were really, you see, we haven't lost those the entire leg up there. And then we finally lost it over the weekend. That said, like there was a lot of liquidations and whatnot. You have excessive short interest at this point. So there is the possibility of a V-shaped recovery into the end of the month, but I think we're kind of on a limited time frame to make that happen. So if you were looking for a V-shaped recovery, what would it look like, right? And I think that would be something like price reconquering this 67.5 level on high spot volume, and then basically an acceleration back up above 70K within the next week or two. But that said, it's going to take a lot to get it there from here, right? Like we need some kind of catalyst. There's obviously been strong rates, and the strong DXY is making its effect known on markets right now, which has been difficult. It's been difficult for price to find a bid in this area after how much it came up, right? Like there's just a natural profit taking. It seems like there's kind of this endless supply right now above 70K. So has that been exhausted, and is price free to expand from here? That's what we'll have to wait and see. If price can, I think it'll probably squeeze in the coming days, but most likely what we're looking at is some kind of like chop formation. Like we've been seeing like this kind of low volatility chop where price comes up, squeezes shorts, comes back down, takes out the people that entered on long liquidity. And we just kind of end up in this endless range, maybe down to somewhere between like 56K or right here, you see, and maybe we just keep bouncing between this lost support line here, and we form a new support here, and we just kind of end up in a low volatility chop for the next few months. And then obviously there's the liquidity Armageddon scenario if we want to get into that nightmare.
Okay, so just to lay out the picture for what you're looking at, if we're going to get a V-shaped recovery, you need to see it get above the 70K relatively quickly in the next week or two. I know we'll talk about outside forces in a bit, which may make that very low probability. Can that happen on perpetuals just burning out all the short interest? Do we really need to see spot? Like, I mean, do we need to see some ETF flows coming in to make that V-shaped recovery a reality?
Yeah, I think so. I think in the case of it, just a short squeeze, we probably wouldn't see, maybe it would wick beyond this 50-day for a day or so, and then it would eventually fade back down. What you would want to see is as we get to this 50 days, increased spot interest really driving the price up through there rather than just kind of a perpetual short squeeze. So you would look for that on the spot volumes, Coinbase, Bitfinex, etc., and see if they're the ones driving price action over here. If we get it, in that case, I think the odds of us going to new all-time highs are increased. But we'd have to see what that reaction looks like if we get back here. Like we saw it yesterday, we came back up and almost retested it perfectly and rejected. So that looks like it's support flipping into resistance, which isn't good. And you can see how momentum tends to fade after you lose that 50-day moving average over time. So we saw it in January. It took about a month for price to recover back above it. We saw that back in the summer months. Price was just kind of chopping around, faded, and then ultimately broke down below the 200-day. So anytime you're trading below here and kind of forming a new channel, the odds of it dropping to the 200-day within, not to say it's going to happen tomorrow or next week, but the odds of that retest coming just become greater. So until it reconquers that momentum, the odds of a bearish chop or ultimately drop lower become greater. So you really want to see that momentum flipped.
So walk through the bearish chop, because you just gave a perspective on the V-shaped recovery. But from a bearish chop, do you just see this going through the next quarter, and we continue to just range perhaps lower around the 100-day to the 50-day?
Right? Like, yeah, maybe we just. I think a bearish chop scenario would be we kind of take out the lows from Saturday, recover, you go back up to 63. It just keeps forming lower highs, right, and just kind of stays in the channel. Bouncing back and forth, you would see the implied volatility index fall the way it did in January, how it just plummeted after the ETF announcement. The IV, which has been going on for a few weeks now, it would just continue to fall. Like there would be no volatility in markets. It would just create a very boring range, predictable, where Bitcoin's not going to say break above 64,000. It's not going to go below 55,000. You just kind of end up in this never-ending sideways pattern, possibly through the summer months, probably at least until the end of quarter two, I would say. we start taking out these lows and don't make a sharp recovery here, that's probably the most likely scenario.
Okay. Well, and we have the other scenario that's on the table, which is the dreaded liquidity event. I want to bring Ben back to talk a little bit about that. Because I know we want to get into outside forces, but before we do that, before we kind of trend over there, because I know it's going to be kind of a heavy macro discussion. JJ, you laid out two scenarios. One is this V-shaped recovery. One is the bear crawl. Which of those is being signaled, if it is at all, on the options or on the perp market? Are they still just hedged for either scenario, or have they started to vote with their dollars which way it's going to go?
There's been some betting on May options in particular. We wrote about this last week, just how much increased demand was coming for these May expiry contracts. Let me see if I could pull it up here. But I mean, I think that was mostly due in part to people rolling their exposure. They had exposure into April. You know, you close those positions out as it's clear Bitcoin's not going to make a move above 70K in the near future, and you roll that exposure forward. So whether or not it's actual bullish betting remains to be seen. There was some large flows yesterday, in particular over 6.3 million bought of May $69,000 calls. But again, that could be somebody de-risking their spot exposure, and maybe they had billions worth of BTC. They sold it all and they just bought some calls to hedge out. It hasn't really been any kind of decisiveness from the options market. And we see this in the IV, right? Like when the options market's ready to go, you'll see the IV start rising to new highs. But every time this has spiked, it's just been presented with selling. People are taking that opportunity to harvest yield in the form of selling out of the money options. And it seems like that's kind of been the trend. And that seems to be the path the market's favoring, is that chop scenario where IV continues to bleed in the coming months and there's no real cataclysmic event, and there's also not an acceleration to all-time highs.
And to your credit, JJ, you wrote, I think over the weekend, of how this regime of just selling volatility as soon as it presents itself in the market, you know, and when that's going to shift, which I think you alluded to is kind of the end of May. But there you see it right there. We had the sell-off. We had every kind of opportunity for implied volatility to just go parabolic, and it already got smashed down within like 48 hours.
There was that window of opportunity last week where it spiked up and it seemed like, okay, maybe it'll catch a bit, like maybe CPI would go favorably and we would see kind of a return to the highs with volatility accompanying it. But obviously the macro didn't play along. It just was another volatility selling opportunity to just capture. Like, you look at how extended it is, obviously it's higher than it was at any point in 2023. So from volatility seller's perspective, these are pretty good prices to sell at, especially if you're holding spot exposure with how much premium these contracts are commanding currently. If you think price is just going to be choppy through the rest of quarter two, you can really harvest a lot of yield. Like we saw that with the halving. Those options premiums were insane. We're pointing out, like in March, even after the all-time highs, like even after we peaked and we were back trading around like 67 to 70K, like $90,000 calls expiring at the end of April were trading for a few thousand. So like it was way overpriced for the odds of Bitcoin actually going to there. And this is kind of like a sell the news. It was a sell the news event for the options market where they just took advantage of that high premium, that FOMO demand, and ultimately profited big. So yeah, that plays.
Yeah, options makes you really have to think ahead, because it was almost like the volatility started to present itself. And everyone was thinking to themselves, oh, but the halving is going to have even more volatility. So let me go ahead and start hedging myself for that event, and feeling like they're really doing the right thing. They're being smart and wise with their portfolio. But the truth is that the market was already positioned to go ahead and collect that premium that it was charging for those that were thinking that way.
Yep. It's 3D chess for sure. It's always priced on the future.
Let's kind of pivot right now to, I think, the outside forces that we talk about being the Dixie rates, perhaps oil, and what that can mean for price, because it feels like what we just saw over the weekend, so this liquidity drain that happened was off of macro event, the potential Israel-Iran conflict. And now we're seeing the Dixie higher, we're seeing rates go up. So I want to touch on that and then play into this last scenario, which is the liquidity Armageddon. And then obviously beyond that, we want to get into what the opportunities may look like once that's done. Before we do that, though, I would definitely want to give a shout out to everybody who's here. Again, I want to thank everyone for joining us and being here every Tuesday and Thursday to to really get some of the news. I know we don't always have the most bullish sound and we're not always the most positive, but we're definitely trying to give you the most realistic on the ground feel that we can, so you can be thinking about your portfolio and how to actually play that. But let's just dive in directly into this scenario. So you just walked through two scenarios: the V shape and the bear crawl. V shape obviously is the bull one. Bear is, as its name implies, sounds like just a dangerous animal walking down the streets of Dubai right now that's all flooded. What are we seeing with the dollar? What are we seeing with oil? What are we seeing with rates? And what does that mean for outside forces, JJ? Because you're always knocking us on that. You're always telling us make sure you're aware of those, because they could definitely present the churn in the markets that you're not prepared for.
Yeah, I mean, the dollar's just been on charge for the past month, basically since the FOMC. We had that kind of brief sell-off here, and then it's just been this never-ending uptrend that's just accelerated since last week's CPI, and then macro fears over war and whatnot has just sent things ever higher. And you see that in the December rates. We've been covering this. Just when these go low, it's an indication that the market's expecting higher rates by the end of the year. And it just seems like this chart is bottomless, keeps falling lower, which indicates higher rates, and that's been strengthened in DXY. That said, it's overextended, so we'll have to see what Powell has to say today. Obviously, some liquidity fears in markets right now. So does he try to quell that and kind of signal that a rate cut will come, or does he just stick with the script and encourage the market to go risk off? It'll be interesting to hear what he has to say, and how ultimately how Dixie and the rates markets react to it is the most important part. So his rhetoric's kind of second to that. It's more so these markets will tell you what the actual meaning of his speech is if you just watch them closely. So that's what I'll be keeping an eye on today. But it's not looking good now. Like it is what it is, right? Like this is a clean breakout from Dixie. It's strong. It doesn't look like the kind of momentum you want to be in a rush to fade until you see some kind of confirmation from the market.
Ben, I want to bring you up here. The Dixie's looking strong. You mentioned offline this morning, you had the first signal that maybe the narrative was shifting to a possibility of not a rate cut or rate stabilization, but actually a rate hike later on in the year. And that was something you were looking for. What is the rate market telling you right now?
Yeah, man. I don't want to sound just like overly bearish or anything. So I'm going to try to
just
tame
tell
my
us,
words.
Tell us like it is. Tell us like it is.
Like it is. If this is just kind of act one, act 2 and 3 are just right around the corner. When we think about when we look at the dollar chart, just to kind of start it off, like it was going parabolic. It was making its move, and it was a bit worrisome. And I think about 2 weeks ago, JG and I were discussing of how strong it looks, and also how the market doesn't seem to be really appreciating just what the dollar was signaling. And you almost had this kind of bipolar market where it wasn't fully kind of believing the same script. And I think right now, this week, we're kind of, those that were on one side and were wrong are starting to come to consensus that, hey, look, the dollar is strong. The rates are going to be a little higher. And the cuts might not be as forthcoming as we initially thought. And last Tuesday, the other thing is inflation. I think we were discussing that the market didn't really quite believe it, and it had its moment to go ahead and push back and question these figures a little bit. I think I saw a headline that said like home insurance is not being priced into inflation, so these aren't real numbers. And if it was, oh man, we would really be seeing some high figures. And just seeing headlines like that was sort of the confirming that this is the market pushing back, that it doesn't quite believe that inflation is beat. And so that caused this discussion around rates again. And I think this morning, I think it was the UBS analyst, Pringle, I think it was his name was. I tried to search it up this morning. I couldn't find it. But he apparently is one of the first analysts to go ahead and discuss a rate hike, not a cut, but a rate hike as being a possibility. And this is kind of on the heels of inflation. So that inflationary kind of bluff, if you will, being called has forced this question, has allowed this question to come in. And now you see the market starting to reprice everything. Is the conflict causing some of this? I'm not a geopolitical analyst, so I can't really add much color there. But if I were to be trading oil future markets, like I would try to hedge and look at contracts, and that's going to cause these pricing changes. And if you're a company that essentially needs lower energy costs to go ahead and make greater margins, like that's going to hurt you. And so if we think about what's happening with kind of the indexes, and you see those sell-offs happening, this is a real event. This is really getting repriced in. So now you have the discussion happening, whether it's inflation, rates, or even the conflict. This is causing these vibrations throughout the market and people to take note.
Okay, so much to unpack here. It is, again, such a meaty topic with all of these variables taking place. Ben, I want you to relay out the Liquidity Armageddon event with the backdrop that you just gave. What exactly is it for those listeners who maybe haven't heard about it before, but we've talked about it on this show? And how do you think the current setup is, versus when we started talking about this back in January? How much closer is it moving towards what that liquidity event and triggering it?
Sure. I mean, the dollar is getting stronger. And the other part of this is that, if a central bank starts to go ahead and cut its rates in anticipation that the U.S. Federal Reserve is going to follow suit within the next 3 to 6 months, you're essentially lowering the cost of your currency. Well, central banks around the world have started to go ahead and cut those rates in anticipation of the Fed. And the Fed now is sitting there saying, maybe not. Maybe we won't. I don't know. We'll see. I mean, we'll see what Jerome says later today. But that right there kind of causes a lot of banks to be offsides right now. And then you have the dollar ripping. You have the repo market, which is essentially dry powder that exists, that's sitting at the Fed. And the Fed can go ahead and say, look, we don't really want your money. Go ahead and move it into the treasury market. Go ahead, find some other form of yield that exists in the market. So they go ahead, one peg down the risk curve, and now you're winding up at the treasury market. And so those dollars end up there. But that's starting to get drained pretty good over the last, I guess it was 24, 48 hours. It's down 20%, which is pretty significant. It's kind of I would say the largest move of the year so far in the repo market. And you do have yields starting to spike as well. So you would think if you were to have that amount of dry powder enter the treasury market, yields wouldn't be doing what they're doing right now. They would be coming down a little bit. So the question I think at the moment is the repricing in the kind of the longer term yields, like the 10 and the 30 year. Is that because the Fed might actually raise rates versus cutting them? If so, that curve needs to go ahead and kind of come up on the longer duration. But at the same time, you had that much dry powder coming into the treasury market. And why aren't you seeing the response that you would? I believe there was an auction that happened last week. I know caught a lot of people on the headlines saying this is like the worst auction in however many months. But at the end of the day, this is just look where the yield is, look where rates are right now. Like this has to happen. And so this repricing event is happening. I wouldn't get too bent out of shape over it. I think the cautionary tale is that you're seeing the repo market getting drained as the Fed has explicitly said they plan to do, but then you don't see yields doing what they're doing. You have central banks starting to be caught off sides. So where is this going to leave us? And I think that poses a lot of questions in terms of how is liquidity going to be in the second half of 2024?
What is liquidity going to be in the second half of 2024? There's two minds, right? One mind is that we're going to continue to see this restriction. The headline is that we're going to continue to see this constriction if they keep rates as is, or if they actually, as they're starting to talk about, even raise rates. There's a different side of it that says they're going to find stealth ways to continue to inject liquidity into the market. JJ, I want to bring up the conversation we were having before the show started. I think you were looking at some information that basically said just that even though we're seeing the headlines saying, they're cutting liquidity to the market, we were actually seeing some stealth liquidity come into the market, which was helping to boost those prices.
I think that was what happened in Q4 2023 to present. So now we're kind of waiting to see if that continues again. But basically, if you look at what happened here with DXY top of the SPX 500, like we had this scenario in October, right, where you had the Dixie flying off, rates were low. The rates were around the same level they are now. And then all of a sudden there was we had a lot of bond market turmoil at that time too. It was like September to October time period. You saw SPX break down far below its 200-day moving average. And then all of a sudden DXY leveled off, right? And we had all of a sudden rate cuts start to get priced into the market. And you see how quickly all asset markets, it wasn't just the SPX, it wasn't just Bitcoin, everything just kind of went on this perfect ramp up, likely due to some liquidity that was injected. We saw the RRP fall. I forget how much, a few hundred billion, right? So that liquidity was coming in. It ultimately boosted asset prices. They were priced for this perfect scenario where we would have rate cuts in 2024. And now all of a sudden, especially post last week's CPI numbers, we see everything kind of starting to reprice itself for a scenario where that doesn't happen. As we see here, the SPX, just like Bitcoin, has lost a lot of momentum, broke down below its 50-day moving average yesterday. And it's just not looking good for equity markets at this time. So the question does become is like, do they intervene again? Do they do something in stealth to weaken the Dixie? Kind of the similar effect that we saw in October? Or are they just going to let this thing run off and let all that liquidity drain out of markets and give them a reason to cut, right? Like if they are looking for kind of a reason why they should cut, you could pretty easily find that by allowing equity markets to sell off in short order. So that's what I'm looking for to see how Dixie reacts. And I think it'll tell us like if more liquidity is coming in, we should see Dixie fall and that kind of pressure release from markets and they would find a bit up. But if this thing just continues up, that's telling you that there's liquidity leaving markets and you need to be aware of that.
What about Bitcoin? I mean, this is, I think, a question I keep asking myself. Like, is there a scenario where it actually rises if we start seeing liquidity crunch?
I don't think so, at least not in the short term. I think that could be something longer term, but you think about it, right? Like the people that own Bitcoin by nature, the whole bid up that we've seen since January, these are people that are trading stocks as well. So there's obviously like a lot of cross margin going on and whatnot. And I just think that it can't be contained from a sell-off. I don't think it's as isolated as we would like to believe it to broader equity markets, like similar to the way gold is. I don't think there's too much cross correlation between gold and the broader equity markets. I don't think the holders are necessarily the same people, but I think the overlay of people that own, like say NASDAQ stocks and Bitcoin, that's probably a pretty high correlation. So as you see a sell-off in one, I think people will be forced into selling the other.
And I tend to agree there. And when we go back to, I think 2020, let me pull it up on my chart here just to make sure I got the right stats here. March, where are you? March 2020. Yeah, we did have a pretty steep sell-off initially on gold. If we look right here, we can see this is March 10th, 2020. Gold went ahead and went from nearly 1,700 and it wicked down to about 1,450. And then it went ahead and went on its run. And I believe Bitcoin did a similar setup. It had a massive sell-off. Arthur Hayes went in, saved crypto for anybody that remembers it. I remember that vividly, watching every tick. And
it did bottom.
I feel like
Bitcoin and gold bottomed before the SPX back in March 2020. So I think something like that should be your base case, where literally everything, all correlations go to one, everything crashes in tandem, and then you wait to see what rises from the ashes first. I think there's a decent chance Bitcoin could be the first mover and outperform like equity stocks in the event of a liquidity sell-off, but you should be prepared for downside if that hits.
In that case, like we should kind of make this more of a point, which is like if Jerome talks today and he does absolutely nothing about some of these risks that are starting to present themselves in the market, then the market will kind of force his hand. Like if Jerome is starting to allude to the fact that maybe he's a little bit worried about certain things, then the market's going to push. And if we get into that environment, then you will have that correlation start to get closer to one, where essentially every asset starts to be moving in the same direction.
Ben,
and if that's the case and that forces his hand, and we see some sort of reaction, I think that's when the narrative that Bitcoin really wants to have will start to go ahead and take hold.
Ben, I want to ask about that. The notion I have right now is that there's less concern about the prices, asset prices changing, specifically to equities, not necessarily to home prices, uh, and really more of a focus right now on the jobs report. So as long as the labor market stays strong and inflation stays elevated beyond what they want, there is very little impulse to try and bring rates down. Now, once the labor market starts to crack, or we have one of these other fallouts in some of these other markets, so like if the commercial real estate market breaks down, or if the commercial paper market starts to break down, or banking sector starts to seize up, yes, that could change. But right now, it's really it's inflation being a pest, and so rates can stay elevated for a longer period, and then the labor market. Do you think that that's an accurate assessment? Or do you think there is some concern about the equities and the fact that they are bubbled up to where they are today?
I think it's call and bluff season right now. And some of these concerns have been very legitimate for a long period of time, especially when it comes to the workforce. I mean, the amount of times I've heard people question the stats that they use, like the JOLTS report or whatever it's called. And people and economists, analysts point out to like really kind of flaws in the data, and it's very warranted and deserves a second look, but the market doesn't react to it. Now, I think the market will start reacting to it. And this is what I mean by the market will start to call its bluff, start to move based upon all these headlines that start to percolate into mainstream media. And I think I was just looking at last night. I don't have the chart up, unfortunately, but it went ahead and looked at wage growth based on demographic. And it kind of just really hones in on some of the stress points that exist within the labor market, which is just most of the population is not realizing this growth. And it's not as strong as we're kind of being told. So when that bluff gets called, what are we going to see in response? I don't know. I mean, Tesla's news event here is not helping markets at all. It's not helping the Fed's point at all. And if you look at these major indexes right now, the Dow and the Russell 2000 are moving to the downside pretty significantly, but the NASDAQ hasn't really moved as much. And so if we're starting to have that question get called here and the NASDAQ starts to respond accordingly to the downside, that's that reactionary moment that we're all kind of waiting for.
Okay. So if the market starts to call their bluff, we could start to see reaction. I want to take this conversation, pivot a little bit to talk a little bit more about how, from an investor or trader standpoint, you can actually think about how to play this, because it sounds like the odds are starting to stack up that we're going to see. If I take the whole card of what we've just been talking about, it sounds like the more likely scenario is bear chop for a while, and the increased likelihood of a liquidity Armageddon event that could actually cause prices to go down significantly, which would be a great buying event if you've got powder on the side. So I want to talk a little bit about that. JJ, obviously go into maybe from an option standpoint how you would position for that, and then Ben as well, how you're thinking about that. Before we do, I do want to give a shout out to CoinCall. They are the exchange that we talk about often, or every episode that we have, that JJ is always using for his options positions. And if you're interested in starting your options journey, that is definitely a place to go. Check out the link in the description. They have a very elegant interface, and you can be trading perps, you can be trading options and spot. But if you're interested in actually starting your options journey, and I'm telling you right now, as I do every time, it's almost a PSA at this point. Now is the time to start doing your smaller trades, your paper trades, so you can be accustomed to looking at the options chain, seeing the changes that you have in IV and how that impacts the prices of these options. You can get prepared to make those plays when the setup happens. And as we just talked about, it may be happening sooner rather than later. So definitely go check that out if that's a journey that you're on. Okay. I want to take us now back to the discussion of how to position for this potential liquidity event. And maybe it's talking, maybe I'm getting further down. Maybe I should ask myself, how would you position for these three different scenarios? So JJ, I want to kick it off to you. Before you do that, though, we do have a question from Max Mayer. He's saying, "Good morning. Any views on BTC top before end of 2024, aka left transition cycle?" So Ben, maybe I'll ask you that, or actually I'll ask you both that. JJ, what do you think? Do you think we're gonna have a left transition cycle, or is it too early to tell?
I think it's too early to tell. I wouldn't expect the top to come until 2025 unless the top has already happened. I think there's that scenario, but I think if we do make new all-time highs, it'll continue on throughout the course of the next year or two from here.
Ben, thoughts?
We got a lot of upside left. I know Vinny on Twitter, founder of Civic, has been really kind of trying to have people weigh that possibility, and I don't see it yet. I mean, the more that I look at kind of the historical charts, like on this one, just Bitcoin dominance, if I kind of abstract away a lot of the macro events, abstract away what's going on with TradFi here when it comes to crypto and the meme season, if I just kind of take that all away for a moment and I look at how Bitcoin's behaved, especially around the halving, it looks very similar historically. And so this doesn't give me any, right now, I don't have any pause that the best is yet to come. And I think we had that question at the beginning, and this paints a little color around it, which is, look, I think I even went ahead and did a video on it of breaking down these cycles and kind of breaking them into two, which is kind of the pre-halving, which is where do you want to be positioned before the halving? How do you keep your risk lower? And I understand that meme season made a lot of people money, but I think based on my timeline, it sounds like a lot of people lost a lot of money. And I don't know how much truth there is to that. I think there was a lot of assumptions there, but regardless, the risk was much lower. If you were just sitting in Bitcoin for the pre-halving period, you made sizable money.
Mm-hmm.
And if we go ahead and look at the post-halving sequence, which is, maybe we can link that in the comments afterwards, but there is this progression that it starts with Bitcoin, which we have seen. Then you move down the risk curve to L1s, and then you move into the narrative camps, and then you move down into the meme coins, and that's sort of the last phase. And everyone was really pointing their finger at meme coins saying, look, they're starting to run, so the cycle is over. But there are those mini cycles that happen within a larger cycle. So yeah, the first phase is sort of over, but we're getting ready for the meatiest part of the cycle, which is the post-halving.
Post-halving. All right, so there you have Ben's gears within gears conversation. Don't get overly worried that the best is over. Obviously, outside forces are going to play a role in that, and that's what I want to kind of talk about now is positioning for that. But I think good perspective there from Ben. So JJ, I want to kick it over to you. I'm going to ask the very first question: is now the right time, yes or no, to sit on your hands?
Yeah, absolutely. You wait for this. You just wait for it to resolve itself, right? So we'll see in the coming week or two into the monthly close, like, does it regain this momentum and ultimately close above here? In which case, I think we're headed back to all-time highs. Or does it confirm that we're in for choppiness or more downside ahead? And I think the market will tell us here. And this is not a range to be taking bets. I don't think so. I think you just kind of wait and let the market come to you here. Like we had this uptrend, lost it. So now you just want to wait to see how this ultimately resolves itself.
So you think we'll have some kind of definitive resolution, be it the V-shaped recovery, a bear crawl, those two scenarios in the next 2 weeks, we should have a strong indication which one it's going to be.
Yeah, I believe so.
Okay. All right. So let's say the V-shaped recovery. How are you playing that?
If we get a V-shaped recovery and we see that 50-day break on volume, I'm going with calls. You could go. I would probably be looking at something in June, somewhere 75 to 80,000, and ride those through the end of the year.
Okay. Now we get the other scenario. We get the bear crawl. What are you doing?
A whole lot of nothing. You let the IV fall to you. Like, you look at this chart, you can see if it kind of falls. Maybe it makes a higher low here as opposed to February where it fell all the way sub 50. I don't know if we'll be that lucky again to get IV at those levels, but anything around 60 or so, I think that's worth taking some longer dated bets on in the options market. You could buy some calls there, or that would be like just a bear crawl, like where we do ultimately nothing through quarter two, price just chops between 57 and 64K, and price is boring. You see the IV levels just fall off a cliff, and I think that's where some implied volatility calls would get very attractive, especially if we see signs of Dixie topping in that same time period. I think that's kind of setting you up for a fat pitch into the end of the year.
Is this also a good time to be DCAing in
Depends, right?
for spot? Yeah.
I don't know about right now, just because I do feel like that liquidity Armageddon risk is heightened still. So I would wait. Like I said, I think this is just the perfect range to do a whole lot of nothing. Stare at charts and make some battle plans. That's about it.
Okay.
Maybe sell some volatility if you've got covered spot. You could sell some out of the money calls, something like that, and just chill.
All right, go get a break, maybe in somewhere nice and warm and sunny and relaxing. Ben, I want to bring it over to this Armageddon liquidity event. I know we've talked before about trading that, but I want to get your perspective now. What are you looking for? I guess when your spidey sense is going to really tingle that this is really happening? Is it going to just be event driven, or are you looking for a date and time, or more of a period, Q2, Q3?
That's a good question. I think if the NASDAQ, let's pull up the chart of the NASDAQ.
Not looking good.
It's not. It's not. But if we're breaking that 100-day with velocity, I'd be pretty worried. I would be very worried. Let me change my tune there. I would be very worried if we break the 100-day with a lot of velocity. What else would we see? We would see, I think, initial spikes on yields, similar to kind of what we're seeing right now. 30 years just going parabolic. A lot of that's just repricing, as we mentioned before. But as soon as you see that start to get stomped lower while the Dixie's starting to rise higher, that's sort of that's a worry sign right there. That means everyone's starting to flee into safety, and it might just be the early innings of everybody going risk off, full bore. So that right there, if you see the divergence happening there, I think that's your trouble. That's your warning sign.
Okay.
Yields start to go down very quickly because now they're repricing. The market would be repricing for a cut, and this is a forced cut. This isn't the Fed doing what they were doing before, where, hey, maybe we'll do 25 basis point cut lower. Maybe just kind of give a little bit of recovery because inflation has been beat. This is like oh man, something's breaking. We need to go ahead and conceal it a little bit. And let's do that with cutting rates 50 or 75 basis points, which I think for anybody that's really been trying to predict rate cuts, that's always really been the situation. It was always like a binary outcome. Either rates are kind of unchanged or they got to go ahead and do 75, 100 basis points because their hand's being forced. So you see that repricing on yields. That's a cautionary note while the dollar's starting to run higher. Yeah, that's a big warning sign to me.
So in that scenario, there could be a V-shaped bounce, or it could be a bleed out, right? So what do you anticipate? I feel like in 2020 when we had the mass sell-off, it was more of a V-shaped bounce. Would you expect something more like that, or would it be more of a continued slow grind up as the market starts to adjust to this rate cut?
Yeah, I mean, if the Fed's going to go ahead and take the stand after such situation arises and they open up some brand new facility that is going to save the world again, similar to kind of what we saw beforehand, that is your cue to go ahead and get in the market. I think it's going to be a V recovery. I think it's going to be very fast. The markets are going to be very hot. They've already been hot. So as far as crypto is concerned, that V recovery is going to happen at an insane speed. You're going to have Wall Street queue up the marketing and how fiscal policy, monetary policy has been so terrible, and it's always terrible. And so now hedge yourself, buy Bitcoin. It's going to come on. So, well, yeah.
So there you have a indication. So signals of what to look for this liquidity event. And then I think from a trading perspective, investment perspective, it sounds like the easiest play would be to have some dry powder, be able to deploy it once we see the Fed start to step in.
Yeah. And the one that I really hope to see is more of the bear crawl scenario, because that would allow implied volatility to start to get suppressed, prices kind of inch lower, and that allows you to get kind of long-term call positions for the second half of the run that can be extremely profitable if played right. So I would prefer that because the upside would be much greater than having a liquidity event, kind of a V structure take place on the price chart. Powell come in and change that direction.
I'm already imagining a meme of Powell with a Superman shirt going around on X because he just announced that they've got the new repo facility 10.0 it's got 10 trillion ready to deploy and stabilize markets. You think that's what happens? Is that my prediction?
Brand new facility. You're gonna love it. Same as the old.
You're gonna love it. He's building everything. Well, guys, I think that's going to do it for today's show. For all those out there, again, we appreciate you guys stopping by. Hopefully you enjoyed some of the alpha today, and hopefully this gives you something to think about, not to be depressed, but more of an accurate view on the market, so that you can get prepared for whatever is about to happen. I'm imagining as I look at this, the prices are just about where they were when we started the show. Bitcoin sitting at 62, Ethereum at 3,000, so a little bit higher, 132. But gentlemen, I want to thank you, JJ, Ben, Lily, for dropping by. I want to thank everyone for dropping by. And I'm going to leave this show as I do every time, which is to say, have some dry powder. Be prepared if it's the bear crawl or if it's a V-shaped recovery or it's dreaded liquidity event. You got to be prepared for all three scenarios. And you got to be able to invest when that fat pitch happens. With that, this is Marconi White signing off.